All right, welcome everybody. Today is Wednesday, February 14th. Happy Valentine's Day. We are going to talk about defined risk bear traps. And this is an alternative to what we normally trade, 1-1x bear traps, where we do hold uh, short options naked. I understand that some of our members are not able to uh, place naked short options due to various factors, account size, risk profile, and so on. But that does not mean that they cannot participate in similar strategies that we use. They just need to be set up slightly differently, and um, a defined risk bear trap will have a different trade plan. So what I'm going to do is I'm going to kind of go through steps that I would follow when I look at setting up a defined risk bear trap. And hopefully everyone will be able to follow along. And if you're not following along for whatever reason, or if you have any questions, there is a chat where you can put your questions, and I will try to keep one eye on the chat and answer questions as we move along. So I am sharing my Thinkorswim screen, and we're going to go to Analyze tab. We are going to use SPX for today's presentation, but similar setup could be used for different underlyings, given that the underlying has decent liquidity, has decent implied volatility, right? We don't want to trade something that has an implied volatility of 400, because even though defined risk bear trap has risk defined, right, we still are aiming to potentially capture price within a certain range. And if you have an underlying that has an implied volatility of 400, then it's very likely that the price may shoot way up and completely away from the structure, or way down and completely overshoot the structure where we're trying to capture price. So now I'm going to switch over to SPX. And the reason why I brought up SPX and I said that you can use different underlyings is because I did see a question. Somebody asked me if this can be used with ES options. And the answer is yes. The only problem with ES is that I see ES has strikes available that are 25 points apart. That's not ideal, because if you wanted to make some sort of incremental adjustments or any adjustments whatsoever, if you wanted to roll any part of your structure, you can't do it if you only have strikes that are 25 points apart. And you will see that in a minute. So let's just first talk about days until expiration, right? This is a question that comes up often with 112s, as well as strangles, as well as any other position that involves selling options short. So I often reference, or a lot of times you'll hear me say something like, every trade has the good and the bad, right? Any proposed trade has two sides. There's something good about the trade, and there's the opposite, or the other side of that coin, something that's not good. What do I mean by that, right? So if we just think about selling a put naked, okay, it's something very simple. Selling a put naked. We have one put that we could be selling. Let's say we'll go with 7 DTE, and we're trying to collect, let's say, using SPX, we'll try to collect $15, right? So with 7 DTE, $15 we are selling a put somewhere around, maybe 49.40, right? So 49.40 will give us $15. What does that mean? That inside of the next 7 days, as long as the price remains above 49.40, at expiration will keep all of this premium. That's great. Now, 49.40 from today's prices is about 1% out of the money. If we look at the same proposition, but we go out maybe 90 DTE, right? So the closest to 90 DTE, we have 17th of May, 93 days. The same $15 put, or a put where we get to collect $15, is now sitting at, right, let's call this 42.30, right? So much, much further out of the money. I think with 7 DTE, a put that was paying $15 was like a 30 delta put, which means there's a 70% probability that it will remain out of the money. And with 93 DTE, right, the same $15 put is a delta 6, which means that there is an implied probability of profit to the tune of about 90+%, right? So more DTE gets you to sell your put farther out of the money, which is good, right? That's the good part. You have more room to the downside. That's the good part. The bad part is that you have to wait 90 days, or 93 days in this case, to collect the $15. Whereas with the 7 DTE, you get paid much faster. You don't have to wait 93 days. You get paid in 7 days, but you only have about 1% break even to the downside. So if the market goes down 1%, now your put that is out of the money is now at the money, and you're kind of facing the decision what to do with that put next. So the more DTE you have, the more time until expiration, right? The further you can place your strikes. But in exchange for that room to the downside that you get a much slower rate of decay. So you'll have to wait longer, which is not a problem if you think about it, right? If you have to wait longer for your trades to pay you, you can potentially do a campaign style of trades, right? Where you um, put on new trades every week or every 2 weeks. And then eventually, right, when you close that loop, you'll go from 93 days, and then maybe 14 days later you do another trade, and then another 14 days goes by, you do another trade, and as you're scaling in, or as you're adding new trades into your rotation, some of the older trades will start to come off. So you'll get a much smoother potential P&L graph, and all of a sudden, it doesn't feel like you have to wait all that long because you have new trades coming on every 2 weeks and you have older trades coming off every 2 weeks. All right. So the point is that the closer you are to expiration, the more sensitive your position is going to be to price swings. And there's no right and wrong. I always say that, you do what's best for you. If you are okay with um, wild P&L swings. You're up a couple of thousand one day, you're down a couple of thousand the next day. That's totally fine. Or if you want to have a much smoother P&L distribution day to day, then you go further out in time. But, right, smoother P&L distribution is good. The bad is that day to day, you don't get as much decay. Right? Your theta is much lower, which means you'll have to hold on to that position much longer, and you are potentially exposing yourself, right? If you're holding for a longer period of time, you are exposing yourself to a potential big move at some point in the future, right? So there's always that trade-off. So I think that if we just go back and you know, Tasty Trade has done a tremendous amount of research, and they have lots of data that would lead us to believe that the bulk of the decay in out of the money options happens somewhere from um, 56 DTE down to about 21 DTE, right? At 21 days until expiration, yes, your theta will continue to increase, right? But if you're talking about options that are out of the money, the decay at 21 DTE is going to actually start to slow, and you're going to be more and more exposed to the delta and the gamma, right? So price swings will matter more rather than decrease in implied volatility, or if you're relying on just theta alone, that's not going to help you either. So I think that for a defined risk bear trap, the ideal, or that window where at least I target the trade, is somewhere from 56, maybe 60 DTE down to about, call it 21 DTE, or maybe you could round this off 30 DTE, right? So you don't want to put on a trade that has um, less than 3 or 4 weeks until expiration. And if you do take a trade that has 3 or 4 weeks until expiration, then you'll have to be a little bit more proactive with that trade. You have to keep an eye on it, maybe a couple of times throughout the day. And then the closer you get to expiration, the more time you'll have to spend looking at that trade. And if you go further out in time, if you go to 60 DTE, maybe you only need to look at that trade once a day just to see, where you are and if you need to make any changes. So let's go through a potential setup. So right off the bat, we have April 19th is 64 DTE, and then we have April 5th, which is 51 DTE. Right. So if I was to set up a trade, either one will work. Right. I would probably start with 64 DTE. These are monthly expiration cycle, and this is uh, AM options. And it doesn't really make a difference, right? April 19th is the monthly expiration. These are monthlies. April 19th with 65 days. These are weeklies. These expire on Thursday, and these expire on Friday at the close. Doesn't make a difference because the goal is not to hold the position all the way down until expiration. So maybe to make it simple, we'll pick either or. Let's try the 64 DTE, and um, let's have a look at what is available, something closer to at the money as far as volume and open interest. So now we're looking at in the deltas in the 30s. And I find the most volume and open interest around the round numbers, right? So for example, like 4,900 will have volume of 726 options traded today with 9,200 open interest. And then there's really nothing, right? Very little on the next strike over. Next strike is also kind of little. Then we look at 4,875, right? That's a quarter. So we have 83 volume with 36 or 3,700 interest. So, and that's why I like to use round numbers. But if I wanted to shift my strikes over, I have strikes available. There are 5 points apart, which is what you will not find a lot of times with ES options, right? ES options will have strikes available. There are 25 points apart. So if I wanted to do something in between 4,900 and 4,875, I have to go either 4,900 or 4,875 because there's nothing available in between. And sometimes, 25 points doesn't sound like a lot, but when you're trying to structure a trade with a specific goal in mind, you know, picking one or the other could really change the structure in a way that, it may not be uh, what you are looking for as far as your setup goes. So using SPX with 5-point wide strikes is great. Using XSP, they also have $1 wide strikes because XSP is 1/10 the size of SPX, so that works well too. SPY works just as well, one of the most liquid underlyings out there. You just need to be aware that with SPY, there are physical shares, and if you hold it too close to expiration, and if any of your short options go in the money, you have a potential of getting an early assignment, and that kind of makes things weird because now you're missing parts of your trade. So I prefer to use cash settled instruments such as SPX or XSP. Then I would look at using ES, but the problem with the strikes kind of makes me shy away from it. And also, I don't need to look at ES options because I don't rely on span margin for leverage here, right? I get to decide how much risk and I control how much risk I'm taking with any of these defined risk bear traps. And I no longer need the leverage that span margin offers. And that's why I would prefer to use as my number one go-to ticker symbol would be SPX. Steve saying defined risk trades is all he can trade because he's in an IRA. And I believe that as long as the IRA allows you to trade spreads, I know some brokers don't allow spreads in the IRAs, you should be able to do defined risk trades within the IRA accounts. So let's go and take a look at, for example, this is a typical 112 that I would set up, right? I would look for a 50-point wide put debit spread. So we can go and, I don't know, let's do 49.50. I'll buy a 49.50. I would sell a 4,900 put. This will give me a put debit spread that's going for about $13.60. And we can see the risk graph of what that looks like. And then I would go and I would look to sell something for close to 13 or 14 or maybe $12. And I would do two of those to cover the cost of this put debit spread and then leave the tail profit from the second short put. So a naked put here would be, I don't know, maybe 4,400, right? And I would sell two of these. This would leave me with about a $12 net credit for this 112. All right, so and this is what this structure looks like. We have the put debit spread here, and we have short naked puts that are about 43.82. They're about 12% out of the money. Okay, so we have this big, long bear trap, and we don't have any risk to the upside because we are taking in about a $1,200 credit up front. But this trade does take up about $20,000 in a, that's my mistake. This trade will take up about $40,000 in the portfolio margin account, right? So we'll make about $1,200 in the tail, but you have to tie up $40,000, $48,600 in a portfolio margin account. Not everybody can do that, right? Not everybody wants to hold SPX options naked to the downside because, they stay up at night thinking about black swans or something. So what we can do here is we can structure a defined risk trade, but this is going to, again, we go back to every trade proposition has two sides, right? You have the good and the bad. So what is good about a 1-1-2? Well, the good thing is, number one, we have no risk to the upside. That's great. We have a really wide or really long bear trap, right? We can go down as much as 12% from where we are today and still potentially be profitable at expiration. That's great. But if we black swan and we go down 20%, right, our losses are really going to start to snowball and we could potentially blow up the account. That's the bad part. That's the cost of all this good. And the good, again, no risk to the upside, really wide potential area for profit at expiration. And it all comes at a cost of, right, assumption of risk. If we go down 20%, you could potentially get squeezed out of the trade, or you could potentially blow up your account. So now we're going to look to structure a trade that is a defined risk bear trap. Let me, you know what, I'm not going to get rid of this. We're just going to build a different trade. So we're still going to use the same expiration cycle, 64 DTE. And we're going to go and use a 25-point wide put debit spread. And I'll show you, I get asked, what delta do I go for when looking at a put debit spread? I mean, we can use delta or we can use price, right? We can try to use the same put debit spread. So we'll buy the 49.50. We'll sell the 49.25, right? So that's a 25-point wide put debit spread, and this is what it looks like. Let me just stretch this out so you can see a little bit better. All right. So that's my put debit spread. It's 25 points wide and it's going for $7.20. And then what we're going to do is we're going to sell a 50-point wide put credit spread that's going to cover about 2/3 of the cost of this put debit spread. Right. So we're looking for a 50 wide put credit spread for about maybe $5 or $6. Let's see what we could find and how far out of the money can we go to find a 50-point wide put credit spread that's going to pay us a credit of about $5. I think we need to go somewhere close to about delta 15. So let's try 4,700, right? We're going to sell the 4,700 and we're going to buy a put 50 points lower. So 46.50. That's 4.25, close. So let's try maybe 47.25, and then we're going to do 46.75. That's 480. Okay, that's not it. Let's try 47.50 and 4,700. Okay, so that's 520. Close enough, right? Let's see what that looks like. And this is the process that I go through, right? There's nothing that's written in stone. I mean, we can make some sort of guidelines, right? Like I just said, we're looking for a put debit spread for around 7, and we're looking for a put credit spread for about 5, right? What delta it's going to be, I don't know, right? So I'm going to try to, I mean, I know that to find a 50 wide for about $5, we need to go somewhere around a 15 delta. But is it going to be this 15, 46.95? Is it going to be 46.85? Also a 15 delta? I don't know. It actually, 47.50 is a delta 19. So it's not 15, it's 19 delta. And then when implied volatility will rise, like right now we're in a fairly low implied volatility environment, so Greeks are a little weird. But when volatility returns back to, quote unquote normal, you will see that a 47 50 is probably going to be not a 19 delta, but maybe a 15 delta. So I think it's a lot easier instead of, pivoting around some number that is assigned to an option in the form of a delta. Let's just look for a 50 wide for X amount of dollars, right? Hang on one second. So now let's look at a risk graph of what that looks like, right? So here we are. Now let's just go back for a second and look at what a 112 looks like. All right, so this is a 112. And this is a defined risk bear trap. It says you can see this trade also has the good and the bad, right? Let's try to find what is good about this trade and what is bad about this trade. So we can see that this trade is put on for a net debit. We have a debit spread of $7.40, and we have a credit spread for $5.40, which will give us a net debit of about $2. And if you don't see that, you can look here, right, on this light blue number. If we put our mouse over to where the upside risk is, so upside risk is $200, and that is the difference between the debit spread and the credit spread. So $200 difference, that's our upside risk. Remember, 112 did not have any upside risk. So a defined risk bear trap does have upside risk, which means that if we put this trade on and go to sleep until April 19th, if we wake up on the day of the expiration and the price is somewhere above the long leg of our put debit spread, which is at 49.50, we are going to lose $200. So you can't put this trade on and go to sleep. You have to monitor this trade, and you need to potentially make some sort of adjustments if the trade is not moving in your favor, to remove the initial risk at least, right? So when we put this trade on, we know that we put up $200 up front. Our goal, number one, is to at least recover the $200. And, we could talk about how we're going to do it. But the goal is to try to, remove the upside risk in case the market continues to grind higher and move farther and farther away from the structure or the bear trap. So that's the bad part. The bad part is that we're paying a debit up front, and that is our risk to the upside. What is another thing that is bad about this trade? Well, we have a much smaller or narrower bear trap, right? Our bear trap here is from 49.25, right? This is where the short option of our put debit spread is. So 49.25 down to where our put credit spread starts, which is down at about 47.50. Right? So we have between 49.25 and 47.50. That's where the trap is. And if we look at where our trap was with the 112, right? Our trap starts at 4,900, which is about 70 points out of the money right now. but it goes all the way down to 4,400, right? So much wider range to make a profit at expiration. A defined risk bear trap doesn't have as much range, right? Doesn't have all the way down to 4,400 to make money. But, right, the good part about this is that if we black swan here and the market goes down 20%, down to 39.81, we know that our losses are not going to snowball, right? We know ahead of time what we are putting at risk. And in this trade, the risk is, let's just change the prices so that they're not kind of all over the place and we can talk about the same number. So let's say the put debit spread is going for $7.50 and our credit spread is going for $7 and $5.50. Okay, so there's a $2 difference between the two. So now we see that our risk to the downside, and this is this light blue number, is $2,700. Cannot lose more than $2,700. Doesn't matter if the market goes down 20%, down 50%, or if it goes to zero. And the buying power requirement for this trade is $2,700. Maybe in the portfolio margin account, it's showing a 22 and change, but you don't need a portfolio margin account to put this trade on. This is for those individuals that don't want to have a portfolio margin, or maybe they don't have the capital for a portfolio margin, right? This is a defined risk. We know that our downside risk, if everything goes wrong and we don't get a chance to make any adjustments to this trade whatsoever, the most we can possibly lose if everything goes to zero is $2,700 per one contract of this defined risk bear trap. So if the market goes up and we do nothing else at expiration, we're out $200 to the upside. Or if everything goes to zero, right? If the market goes way past our structure and to the downside, and we do nothing else, if we do nothing else, the most we can possibly lose with this trade is $2,700. Now, how do we come up with this $2,700? Right? We have risk both to the upside and to the downside. Now, we have a 25-point wide put debit spread, and we have a 50-point wide put credit spread. So the difference between the widths of these two spreads is 25 points, which means that if SPX at expiration is below 4,700, right, we are out or we're down $5,000 because the credit spread, the put credit spread is 50 points wide. Our total risk with this put credit spread is 50 points or $5,000 per one contract. So we're down 5,000 with the put credit spread, but our put debit spread is fully in the money and is worth its max potential value is 25 points or $2,500. So we're minus 5,000 on the put credit spread. We're plus 2,500 on the put debit spread. That gets us a net loss of $2,500. And then we're paying $200 to put this trade on. So we add the $200 loss for the debit that we're paying for this trade onto the risk to the downside. So 2,500 plus 200 is $2,700. If we were to put this trade for, let's say, for even money, right? We put nothing to put this trade on. Let's say some way, somehow, maybe we legged into this trade, right? Because you wouldn't be able to do this trade otherwise for even money unless we move strikes around. But let's assume that we paid 750 for the debit spread, and let's say we collected 750 for the credit spread, right? So we did it for even money. There's no risk to the upside. You can see that here we have zero, right? At 419 at expiration, we don't have any upside risk, which is great, right? And on the downside, our risk goes from 2700 to 2500. Why? And how does that work, right? So if that is the case, on the downside, at expiration, if SPX is below 4700, right, our put credit spread is fully in the money, which means that we are down $5,000 on the put credit spread. We are up $2,500 on the put debit spread. So plus 2,500 minus 5,000, that's 2,500. And then we didn't pay anything, and nor did we collect anything. So we have nothing else to add to the difference of these two spreads. So our potential risk to the downside is $2,500. That's never going to be the case unless you're going to leg into the trade. So, or you would have to move your, right? Can we find a 50-point wide credit spread in SPX to pay us $7.50? You bet we can. But it's going to be much closer than 4750, 4700, right? For entertainment purposes, we're going to try to see what that would look like, right? If you wanted to put this trade on and you didn't want to assume any upside risk, right? Maybe we'll move this to 4850, 4800 and see what that looks like. That's 890. That's not what we want. Maybe 4800, 4750. So 4800, 4750. That's going for 715, but close to, so, maybe we don't use round numbers. If we're trying to collect 750, maybe we'll go 48 and a quarter, and then 47.75, right? So 750 and 8, we have a tiny credit up front. So this is what this trade would look like, right? This is the same defined risk bear trap, except we are not paying a debit up front. We're actually collecting a small credit. So let's assume we sold this one for $8. Right, so we get $8 credit for the credit spread. We're paying $7.50 for the debit spread. We collect net credit of $50. So now our downside risk goes to the difference between the widths of these two spreads, which is still 25 points or $2,500, plus we collect a $50 credit, which will go to reducing our downside risk from 2,500 to 2,450. Let's see. Yes, Andrew is saying if we double the quantity of the put credit spreads and push it slightly lower in price, we can get, yes, the trade up will be similar. If you wanted to push your put credit spreads further out of the money and still collect enough to cover the cost of the put debit spread, your downside risk would be higher, and that's bad, right? Higher risk to the downside is bad, but the good is that you get to put your put credit spreads further out of the money, which will give you an implied or higher implied probability of success. In other words, wider bear trap. So you get to decide really where the risk is, how much risk you're willing to take. Do you want to take upfront risk? Do you want to take upside risk? Do you want to take more downside risk in exchange for higher probability of success? Right? This is your trade. You are in control. And that is the beauty of these trades. You get to set it up any way you are comfortable doing so. Right? So this is my typical setup 25 wide. Does it have to be 25? No. It could be 30, it could be 40, it could be 10. It's whatever works for you, right? You have to play around. And if you are on toss, you can, follow these steps and kind of change strikes around and look at different prices and decide, right? We didn't really even get into the Greeks, and you can decide how much upfront risk you want, right? If the market is kind of shaky right now and you don't want to take on a ton of positive delta up front, then put the trade on for a debit and look at what that looks like. Let's call this 550 like we did before, right? So we have 25 wide debit spread, 50 wide credit spread. The difference between these two is 25 points or $2,500, and we're paying $2 up front. So our downside risk is $200. Our upside risk is $200, and our downside risk is $2,700. These are the numbers that we know up front. Now, you can look and say, all right, what do the Greeks look like, right? So we have, to initiate this trade, your delta is 0.2. So you don't really have a whole lot of directional exposure. If the market rallies from here, doesn't really do much, right? We're going to be down a little bit. If the market sells off, it doesn't really do anything. Maybe you're going to be down a little bit because volatility is going to increase. But directionally, we're unexposed, at entry, and that has to align with your near-term market outlook, right? And Bruce is saying, what happens when you increase volatility? Without increasing volatility, I can tell you that if volatility will increase, right, so will the value of all of these options. And since we are positive theta and we are negative vega means that for every 1 point volatility goes up, this trade is going to lose about $36, right? So if IV goes up, this trade is going to lose money, which means your T plus 0 is going to get pushed lower. Assuming, right, that over time volatility is going to decay and the value of all these options is going to decay, right? Negative vega is going to play in our favor. So let's talk about, right, what does a typical plan for this trade would look like, right? Again, because if we put this trade on and we do nothing else, yes, if we land somewhere here inside the trap, what's our downside break even? Let's call this 48, 49.48, and downside break even is at around 47.25. So we're somewhere inside of our break evens or in the trap at expiration. This trade could potentially yield a size, right? So if we make $2,300 inside the trap on $2,700 worth of risk, man, this is, almost a 100% return on risk for this trade. The problem is that if we look at the probability of price being somewhere inside of break evens at expiration, and we can, look at, this is what, April 19th, right? There's about a 25% probability that the price is going to be inside of break evens at expiration. So there's a 75% chance that, we are not going to make the full bear trap at expiration, right? So you can kind of say this is a low probability trade, and that would be a fair assumption. The goal for this trade, though, is to make, maybe 10%, maybe 15% return on risk. What's our risk? Our risk is $2,700. That's what we have to take out of our pocket and put up with your broker, right, in order for your broker to allow you to put this trade on. So $2,700 is your risk in this trade. You're looking to make maybe 10%, so 270, maybe $300, right? If you are up $300, that could be your first target, and then, depending on how close to expiration you are when you get to that number? Um, do you want to hold longer? Do you want to, do something as far as incremental adjustments go to remove some of the risk to potentially stay in the trade for a little bit longer? Right? That's up to you. But we know the risk is $2,700. Our first profit target would be 10% return on risk, so $270. When we're showing P&L 270, that is your cue to get out. Downside risk, right? So if we're going to make $270, do we want to risk $1,500 to do so? Probably not, because this is not going to be um, a profitable venture over a long period of time. If you're risking $1,500 to make $270, so we want to keep our risk and our reward kind of aligned. So maybe I would say, all right, in the best case, I'll make $270. And if things start to get out of hand and I'm down maybe 325, maybe 350, I get out. Right. And then you do this for maybe 6 months, right? Maybe you put this trade on once a week. Maybe you do it every 2 weeks. Maybe you do it once a month, right? Whatever but you need to generate enough instances where, you can look back at maybe 20 trades and say, all right, what was my average profit on any of these trades? And based on that number, you can decide, if I'm going to be on average plus, $250, maybe I'll risk $300, trying to hit that target. But your risk and your reward is kind of aligned, right? You're not risking way more than what you make on an average good month. So this way you can continue to put on this trade however often you put this trade on, and you would have a positive expectancy over a long period of time. So we can see that, just based on this risk graph, let's assume, right, we put this trade on and we can go and, all right, so we have the date, right? And here with Thinkorswim, you can see like this lighter gray area. I hope you guys can see this. This is a 1 standard deviation move, right? So the price is expected to be somewhere between 47.06 and up to 53.36. So we're going to be somewhere inside of this lighter gray area. Our profit really is somewhere close to the trap, because if we move too far away from the trap, this trade is not going to be profitable. And we can look at a projected T+0 line, maybe 3 weeks from today. Today is the 14th, so the 28th is 2 weeks, and then we have March 6th. Right, so this is March 6th. If we move from where we are today up to about 50.83, right, this trade should still be at about a break even. If we move down to about 47.78, this trade could possibly be at a break even. Now, inside 47.80 and up to 50.80, right, this trade, you can see it. If we move down, let's say 50 points from where we are right now. Right now, we are at 49.70 on the S&P. So let's say we go down 50 points over the next 3 weeks. So 49.20, right? Where's 49.20? 49.20 in 3 weeks. And this P&L is showing us about $125 gain, right? Our target is 270, so we're not quite there. But you can say, all right, if I'm up, 130 on $2,700 worth of risk in 3 weeks, that's about a 4.81% return on risk in 3 weeks. If that's a decent enough return on risk for you, maybe you decide to get out. Or you say, you know what, the market right now looks balanced. I think we kind of go sideways and, I'm not expecting a whole lot. So maybe you hold longer because, at 49.20, 3 weeks from now, if you look at your Greeks, your delta is fairly neutral, right? You have positive theta. You're making about $8 or $9 every day that passes, but you're still short Vega. So if you think that volatility is going to continue to compress, you can continue to hold longer. Because if we go forward, maybe another week from March 6th to March 13th, if we're still at 49.20, now you go from being up 130 to up about $200. And then again, you kind of ask yourself, well, if I'm up $200 on $2,700 worth of risk in 4 weeks, right? 200 divided by 2,700, that's 7.4% in 4 weeks. If you annualize that, it's about a 95% return on risk on an annual basis, right? So you kind of always want to check in with reality and say, hey, is this enough? Right? Can I take this off and maybe set up a new trade? Right? That's always an option and a good option. You don't have to hold because the longer you hold, right, the more risk. Like for example, if you held for the first 4 weeks, right, and this is March 13th, and you have until April 19th, so you have about another 5 weeks to hold it. If you held for the first 4 weeks and the market hasn't really moved a whole lot, well, the odds of market making a big move is now starting to increase because the market isn't going to, sit still forever, right? So if you initiated a trade and it kind of, the market didn't really do a whole lot and you're sitting at a really nice profit and you're not really at your profit target just yet, right? You can always take this trade off and move on because now the closer you are to expiration, let's go forward another 2 weeks, right? See, now you see that, right? We are assuming, 6 weeks from where we take this trade, we're still only 50 points lower, which is only about, 1% lower from where we are today, right? What are the odds of market being only down 1% from today's prices 6 weeks from now, right? You have to understand that the market isn't always going to just go sideways. And right, if you are lucky to catch a trade where in the first 6 weeks the market only, maybe it went up a little, maybe it went down a little, but somewhere 6 weeks from now, you're sitting at 1% lower from where you started the trade, and you are up $420 on this trade. So number one, you are already exceeding your profit target, and number two, right, as this hump, and you can see this purple line or pink line, right, is this hump starting to build, and the closer we get to expiration, let's go forward another 2 weeks, right, the more pronounced this line is and the more volatile your P&L is going to be. Like for example, compare um, if you compare the difference in P&L, right, with only a week to go until expiration in this trade, if the market was to move 50 points up or down with 7 days to go, versus if the market was to move up or down 50 points with, like, I don't know, maybe 6 weeks or 7 weeks to go, you will notice that P&L distribution with more time until expiration is much smoother, right? So the longer you hold, the more risk you're taking that if the market makes a big move, your P&L swing is going to be pretty drastic, right? You can go from being up. Let's just go back to March. Let's call this March 27th, right? If we're somewhere here, let's just use this number for example, right? So if we're at like 48.40, if we are down 40 points, we go from being up $430 to being up $340. So that's about $100 swing with a 40-point move. Now, if we change the date from March 27th to March 6th and use the same numbers, right? We go from being up $100 at 48.40. If we go to 4,800, we're only up, $45. So that's a $50 difference in P&L on the same amount of price change, right? So the price goes from 4,840 down to 4,800. That's a 40-point move to the downside. Our P&L went from being up 100 to being up maybe 45 or $50. But later on in the trade, the same move, you go from being up 430 down to about 330. So that's right, same 40 points, but your P&L swing is twice as high. So the longer you hold until expiration, the more volatile your P&L is going to become. So that's why I think that, if you set up, if you set a price target, maybe it's 10%, maybe it's 15% return on risk, even if you're not hitting the target, but the time keeps running off the clock and you're getting closer and closer until expiration, be aware that the longer you hold, the more volatile your P&L is going to become. So I am in the camp of, take profits maybe early and set up a new trade with more time, right? Again, remember, the more time until expiration you have, the less sensitive your position is going to be to price change, right? So the less attention you need to give to these trades. And the closer you are to expiration, the more active you need to be as far as watching your trades and potentially making adjustments if you needed to. So now let's talk about adjustments, right? Like I said in the beginning, if we put this trade on today, right, here's where we are. Our upside risk is $200. And our goal number one, as far as adjustments go, is to recover the $200, right? Let's say that we put this trade on and then maybe 3 weeks from now, right, this is March 6th, S&P is trading somewhere around 49.20, right? We are in the trap, but we're still very far away from expiration because this is only March 6th. Expiration is not until April 19th. But we are in the structure or in the trap. And now we're up, maybe $130. If we do nothing and the price goes back outside of the trap, once again, we have the risk of losing $200 to the upside. So what I would do in this case, if I am here, 49, let's call this, let's add a price slice and put it at 49.20. $49.20, right? So at $49.20, I'm up $128. Now what am I going to do? Well, I could potentially remove my upside risk. How do I do that? Right? I have a $200 debit. I need to collect $200 from somewhere. Well, what if I took the long leg of my put debit spread that is at 49.50 and moved it up closer to the short leg, right? Shrunk the size or the width of this spread, and we'll see what that looks like. So if I'm if I am going to take the 49.50, I'm long 49.50. If I'm going to sell the 49.50 and move it up maybe 15 points, right, to 49.35. And maybe I collect, instead of $4, maybe I collect $3, right? I collect $3 or $300 here. And now my upside risk goes from $200 risk to no risk to the upside, and I actually have a net credit of $100, right? This is what my risk graph looks like before I make any adjustments. I have upside risk of $200. If I roll my long leg closer to my short leg on the put debit spread and collect $300, so now I not only recover the initial $2 debit, I actually have a net credit of $1 or $100 per one contract. But now, right, you can see that this changes my downside risk as well. My downside risk went from 2,700 to 3,900. So we need to plan for something like this, right? So for example, if I was to do this trade and my initial risk was $2,700, um, I would size the trade and I would plan my capital for this trade, assuming for some further adjustments down the line, right? Maybe I say, all right, my initial risk is $2,700, but I'm going to plan to deploy about $5,000 into this trade. At some point in this trade could take up $5,000. That is where I draw my line and I say, all right, I'm gonna, even though initial risk or initial margin is $2,700, I'm going to set aside $5,000, and the difference between 5,000 and 2,700 that initially is required is going to be my reserve to make incremental adjustments to potentially um, control my risk or remove my upside risk and so on and so forth. What I also could possibly do here to reduce my downside risk, if I said, all right, I'm going to unlock my upside by rolling the 49.50 up to 49.35, what I could also do is I can roll my 4,700 maybe up to 47.20. And we can see what that looks like. And if that's not good enough, we could always make changes and move strikes around to where it makes sense. Right. So we are short 47.50 and we are long 4,700. So we would be selling the 4,700 and then buying 47.20. Now that's a debit, right? So we collect $3. Let's make this two, right? So we collect $3 by rolling our 49.50 up to 49.35, and then we're paying a debit to roll our 4,700 put up to 47.20. So now we're only recovering, instead of $3, we're also spending $2, so we're only recovering $100 worth of risk to the upside. In this, right? So we went from being a down 200, we rolled the long legs in, and we were able to remove half of the initial risk. If I rolled my 4,700, not to 4,720, but maybe to 4,710, and I only spent $95, then you can see my upside risk, right? Maybe let's say I paid $1 for this to make it round. So I collect $3 by rolling my long leg on the put debit spread, and then I spent $1 to roll my long 47 put up to 47.10. Right, this is a net credit of $2. So I take in $2, and that goes to remove or take back the $2 that I paid up front when I put this trade on. All right, so now I eliminated my upside risk, which means that if we're sitting at 49.20 and I made this move, right, I rolled my long puts in on the upside and I rolled my long puts in on the downside, right? My downside risk is 3,000. It went from 2,700 up to 3,000. So I'm taking a little bit more risk to the downside, and that's bad, right? I increased my risk to the downside. That's bad. But the good is that I was able to remove or recover my initial debit here. So there's a good and a bad to every single thing that we do when we make adjustments or when we set up new trades. So now, is the trade over? Well, maybe, right? Maybe. Why? Because if I did this adjustment where I recovered my initial debit and the market is kind of pulling in a little bit and then going back up, and it doesn't look heavy, and the market is, it doesn't look like it's going to roll over and die, right? I can just leave this on. I don't want to, but I can step away because I no longer have any upside risk, and maybe come back at some point, maybe in 2 weeks, and see if there's anything else I can do to possibly maybe collect a little bit more credit to the upside, or maybe the price is deeper in the trap and I really don't need it to do anything else. Just kind of let the time go, because we know that the longer we stay inside the trap, right, the more profit we're going to potentially make, because our put debit spread is now in the money and it's increasing in value with every passing day. Our put credit spread that we are short is out of the money and it's going to lose value with every passing day. So now the longer we stay inside the trap, the more both sides of this bear trap are working in our favor. Right? So that's the idea. The idea is to kind of go back, and the idea is to initiate a trade, and I don't mind paying a debit up front, okay? Because my goal is not to put this trade on and go away and, come back to look at this trade on the day of the expiration. I'm going to look at it once a day just to see, what the market is doing. How is this trade behaving? Is there an opportunity for me to do something? But very early on, we don't want to be too active with this trade, right? If we start this trade 60 plus days out, maybe we'll give it the first 3 weeks, right? Unless the price is starting to push deep into the trap where it's going to potentially threaten, right? Let's say we go back to today and we could identify, if we took this trade with a profit target in mind of 200 and maybe $50, right? If I make 250, I'm out. That's my profit target. If I'm down 300, I'm out, right? So those are the two exits for me. Up 250 or down 300. Where am I down $300? All right, we can go down as much as, I don't know, maybe let's call it 4,700. And it's probably going to happen a little bit sooner, because assuming that on the way down, volatility is going to rise and push the T plus zero. But I think that if we get to somewhere about, maybe 47.20-ish, maybe 27.15, right? Or maybe uh, not 27, but 47.10, right? At 47.10, we see that P&L is minus 255. I think if we get down to 47.10 pretty fast in the first couple of weeks, I think this trade is going to show a loss of about $300. That's my exit, right? I don't start to look to make adjustments when I'm down $300. $300, that means it's over, time to close out this trade and get out. Now, if we are moving down slowly, right, just kind of grinding, and volatility is rising and it's putting pressure on this trade, is there any adjustments that I may make somewhere, early on? Yeah, maybe, right? If we're down, um, if we're down to maybe 40, let's call this 4,800. Right. At 4,800, I'm starting to accumulate positive delta. But as you can see on the one lot, right, these deltas are so insignificant. How do you remove one SPX delta, right? Do you short, 10 SPYs? I mean, I don't know, right? So that's why I don't think a trade like this requires a whole lot of babysitting or a whole lot of management, delta hedging. And no, either you're up $250 or you're down $300 per contract. That's where you get out, and you move on to the next trade. Keep it very simple. But if the market does not move, if the market does not move, 4 or 5% in the first 3 weeks, and let's say we're just, kind of back and forth, but somewhere around where our bear trap is, right? The value of this put debit spread could potentially increase, and the value of our put credit spread could potentially decrease. And that's going to show up in a T plus zero that looks kind of like this, right? Where we're maybe outside of the trap, but we are showing a profit, right? And here I could, if I'm, let's say, 4 weeks later after I take this trade, I'm up $180. Maybe that's where I start to roll or shrink the width of my debit spread and shrink the width of my credit spread, right? This should create a net credit transaction, which will reduce my risk to the upside. And the goal is to recover the initial debit, or in this case, $200. Right? So that's the idea. Put on the trade. The difference between the two spreads is 25 points or $2,500. If I'm paying a debit, I add this debit to the $2,500 risk to the downside. So my initial risk is the difference between these two spreads plus any debit paid, right? In this case, it's $2,700. I would allocate about $5,000 for this trade as my planned capital. And any adjustment I would make, I would reference back to see what's my downside risk. If my downside risk exceeds $5,000, I cannot make that adjustment, right? So any adjustment I make, I cannot increase my risk to a point where it will exceed my planned capital, which is $5,000 for this trade. So, and adjustments are very simple. The adjustments are to shrink the width of these two spreads enough to recover the initial debit, and then hold on to this trade long enough until we either hit the profit target, which I think 10% return on risk is very reasonable, or if we're down about maybe 1.25, 1.5 times our profit target, that's our stop. And either we hit one or the other, and then we get out. There's no, you know, trying to reinvent something mid-flight, trying to change our plan. It's very simple, very straightforward. And we know our risk before we take the trade, so we can kind of size the trade. And let's just touch on the sizing before we wrap this up, right? So if I know that my stop in this trade is a $300 loss, right? That $300 per one contract is what you should use to size your trades. So, for example, if you have maybe, let's say, a $50,000 portfolio and you are going to risk no more than 3% of your net lick on any given trade, right? So your max potential loss on any given trade is 3% of the $50,000 account, which is $1,500. We divide $1,500 by $300 is what we are going to lose per one contract in this particular trade, and that gives you your potential size for this trade of 5 contracts. Now, do you have to do all 5? You don't, right? But you can't or you shouldn't do more than 5. You can do 1, you can do 3, you can do 5, you can do whatever you want, but you shouldn't do more than 5. If you do 5 contracts and you are down $300, which is what you plan for, right? You plan on getting out if the trade is showing a loss of $300. If you are down $300 on 5 contracts, it will give you a total loss of $1,500, and $1,500 on the $50,000 account will be roughly 3% of your total account value. Right. So that's how you would size this trade, not based on, right, how much margin you need to put up to put this trade on or how much planned capital you have. If you think about it, right, if you're going to do 5 contracts and you have planned capital for this trade is 5,000 per one contract times 5, that's $25,000. Right. So you're already using up half of your account to put this trade on. Right. It means you have $25,000 left over to use for other trades. But you should always keep in mind how much capital you're kind of reserving for this trade, because if you do have to make adjustments, but you have used up your capital elsewhere, well, now you either have to close the trade or you just simply cannot make adjustments anymore. Right. So you have to think about capital allocation. One contract, how many contracts you're going to do, and you use your um, stop loss number to kind of dictate how many contracts you can do. And from there, you follow the plan. You know where your target is, you know what your stop loss is. And if either one of those numbers are hit, you have to get out. And in the meantime, right, try not to touch this trade for the first couple of weeks. And 3 weeks later, maybe 4 weeks later, if nothing crazy happened, if the market didn't move a lot, you look for ways to recover your initial debit, make incremental adjustments, and hold long enough until hopefully you hit your profit target. So that's the idea. I mean, there's probably a lot more that we didn't really talk about when it comes to again, we can go back and say, why 25 wide, why 50 wide? You can do 30-60, you can do 20-40, you could do whatever works for you. But I think that if you want to get good at this, you want to use a broker that allows you, like Thinkorswim is a perfect broker where you can go and kind of model trades and change strikes around and see what happens when, the price moves, and what happens if you change the date at to some point in the future, how P&L today will react to that, right? So you want to use these tools that are available to you and find the combination that works for you. For me, I think very simple: 25 wide debit spread, 50 wide credit spread for maybe a small debit to start, and then from there we go. If you guys are interested, we can, try to do a campaign style for these kind of trades in a non-PM, right, defined risk fashion, small account size. And, over time, based on our findings, based on our results, we can potentially, change some things around about this trade setup and, mold this into something that maybe we could use, constantly. I'm going to take a look if there's anything in the chat. If not, guys, you can ask questions in our Discord. I'm going to put up this video when it's done in Discord. And if you have any questions, let me know. Otherwise, we're going to wrap this up here. I thank you for taking the time, and I will talk with you later.